Fantastic. We're down to our last panel. I'm fully disheveled here after a full day of events. But this is great. We got a good group coming up. Michael's partner, Duane, is coming online. So gentlemen, I think it's all gentlemen, but thank you. Thank you, Chad. Feel free to stay on. All Brad, Chad, JT, Michael, Nick.
I have to leave so Duane can pop on. So I'm going to pop out and then he'll jump.
All you have to do is close your video, and you can stay on and watch the whole thing and turn your microphone on.
Great.
You don't have to go away.
Okay, thank you.
Thanks,
Nobody
everybody.
can see.
Appreciate it. Enjoyed it.
There's Bill.
I got to leave.
Good afternoon. How are you?
There's Jeff. Long time no talk, Bill.
I know.
Yeah.
Are you
Jay?
surviving?
So in Minnesota, we are not surviving. We're getting word this morning that the governor at 6:30 is just going to shut everything down. So I'm booking. I'm fighting with my dad over who gets to use his Fort Myers house, and I've got it booked from December 4th through Christmas, and I'm out of here. We got to suffer through to December 4th.
Hey,
They're shutting down everything. You know what you're saying?
Yeah. Yes.
Oh, they're shutting it down?
They are shutting down the gyms, youth sports, restaurants. We can freely go about our business, but there's nowhere to go. And it's cold here. Why would I stay here if there's nothing to do? All right, let's get this last panel going. And I'm a little bummed that this is last. You know, the alternative investment guys always get sort of the redheaded stepchild effect. And that's just wrong, because there's really good investment, high quality products. I've thought that my whole career. Love what all of you do. And then we throw in Tim, who's the cost seg guy, on the same panel, but it fits in. We're going to make it all work. So stick around, please. There's lots of good information here. It looks like people are sticking around. So pretty good with that. Thank you, folks, for sticking with us for the long day. Okay. I'm going to try to do introductions. Usually I make people introduce themselves, but I love everybody that's on this panel. So I'm going to give it a shot. I'm starting with Bill Exeter, 1031 guy, extremely well known around the nation, but you're in sunny California, where you're probably also shut down. If you all want to mute your microphones so we don't hear background noises. I can't quite tell who that's coming.
yeah, that's right.
That's Chad. There we go. Boom, done, gone. You get booted out if you're making background noise. So Bill's kind of a 1031 genius, seen a lot of deals. He's going to help us wade through this stuff. I'm going to have him kind of co-host with me and kick us off. Then we got Jeff Hertz, Cantor, Fitzgerald. They do investment products in really nice properties, and they do some DSTs. We're going to focus probably most of the time on DSTs. And same with Duane Lund, who's below him on my screen, NAI Legacy. Duane's been around real estate longer than I have, and I've admired him every step of the way. And like Michael, they work together, have some great stuff to offer, and great platforms. It'll be fun to hear about that. Jay Young, if you would all pay attention to oil and gas and you don't know who Jay Young is, you've been hiding under a rock, because he's a celebrity in that industry and he's everywhere. And he's charismatic and fun to talk to. Last but not least, we got Tim Ivettson. I hope I'm saying your last name correctly. Cost seg guy extraordinaire, really does, I think, a top-notch job, and a great person to get in contact and stay in touch with. So Bill, let's go to you. And just a 1031 update. I know you guys did a great 45-minute panel on 1031, but we're talking as a net lease conference. So if you could sort of focus a little bit on net lease as a replacement property, the 1031 process, what's changed, and what other things we've got to think of. And if you could segue into helping us talk to Tim about, if you did a cost segregation study, how to be smart about your 1031.
Sure, absolutely. Well, certainly today we have all sorts of challenges, whether it's fast-paced market, low inventory, getting multiple offers, bidding wars, depending on the asset classes you're talking about. We have the COVID-19 lockdown. Unfortunately, Todd, you're the right there in the middle of that whole thing. So all of this affects, doing the 1031 exchange. Some folks can't get out of their house to go look for replacement property and what have you. You're getting a lot of folks, I think, from the trends we've seen, where they're getting out of retail, or at least looking to reposition retail. And there's certainly a lot of folks looking at net lease thinking, this is, I think, where I want to go. It's a lifestyle decision, quality of life decision, get out of the retail where they're exposed to maybe folks that may have COVID and going into something where they don't have as much management or any management to worry about. So that's certainly a trend that we've seen and will probably continue. And then, we have the alternative investments, which we're talking about today. And the Delaware Statutory Trust is one. We'll get into that. We have oil and gas interests, water rights, mineral rights, air rights, et cetera. And that always surprises a lot of people when we get into all those fringe investments that qualify. And then they're kind of shocked. We do seminars literally, and today we're doing a ton of webinars every week. And it always shocks people that it qualifies. And so I quickly want to touch upon that. The two real requirements there for a 1031 exchange is the property you sell, the property you buy have to be held for some type of qualified use. That just means it's got to be some type of rental, investment, or business use. And so all of these we're talking about today qualify for some type of rental, investment, or business use purposes. And then it's amazing to me too how many people still get the like kind requirement confused, where they think it's condo for condo or apartment for apartment, and et cetera. And it's not true. Like kind literally just means you're selling real estate. You have to buy real estate, simple as that. So that's relatively easy to satisfy. So it's really the qualified use that we look at. And all of these things that we've talked about, the Delaware Statutory Trust, oil and gas, water rights, air rights, mineral rights, are generally defined under state law to be real property interests, and they're all generally acquired and held for investment purposes. So they certainly all qualify. One of the things we see is clients who have a relinquished property they're going to sell and dispose of, and they've performed a cost segregation study on that. Now, pre-2017, it was relatively easy to deal with that, because they've elected at some point in the past to have a cost segregation study performed on that. And Tim could go into more details as to exactly what that is, but they've really carved some of that property out as personal property so they can accelerate their tax or their depreciation deductions on their tax return. Then they go to sell the property. Well, now the question is, what are they selling? Is it real estate or is it personal property? And pre-2017, we could set up an exchange that included real estate and personal property. The investor would then do a cost seg study on the replacement property, and we could make sure that the real estate was an equal or up in value on just the real estate portion. And then on the personal property, we could make sure everything lined up and we had a good personal property 1031 exchange. Of course, the feds changed that. So the Tax Reform Act of 2017, effective first part of 2018, eliminated the ability to exchange personal property, but it also gave us all sorts of other bonus depreciation. There's Section 179 deductions, et cetera. So a lot of this may be a moot point because you may recognize gain on the sale of your relinquished property to the extent it's personal property. But with cost segregation, et cetera, you may have all sorts of 100% write-offs that offset that gain. So it's not necessarily a bad thing. We just have to kind of crunch the numbers, et cetera. And the one thing I wanted to point out that a lot of folks aren't aware of, I'm here in California. California conforms to the January 1st, 2015 1031 exchange code. They have not adopted the Tax Reform Act in terms of the 1031 exchange. So California still allows personal property 1031 exchanges. So those who are selling just personal property, whether it be equipment or machinery or aircraft or what have you, livestock, you could still do that 1031 exchange in California. You're just going to pay the federal tax on the personal property portion of it. So with that, I think we could flip it over to Tim to talk more about the cost segregation and what he's seen out there and how they combine that with the 1031 exchange.
Yeah, to put a quick word in for Tim, that just listening to you, Bill, I was unaware of those law changes. It sounds like doing your own dental work. You don't want to do this without being a professional. I'm not going to drill them and fill them myself. All right, so Tim, take us away.
Of pliers. Ouch.
Excellent. Thanks, Todd. Appreciate that. So, and Bill, I think giving that background to people in regards to the consequences of selling and the effect of cost segregation, accelerated depreciation in light of the Tax Cuts and Jobs Act and the changes to how the IRS is looking at personal property, or what we might call 1245 property. And to what Todd was saying, I mean, it's not dental work, but it is documentation. So my message is really very simple to any investor that's on the call, anyone that owns commercial real estate, any broker out there, any fund manager, anyone that's involved in commercial assets. My simple question to you would be, do you have a personal relationship and trusted relationship with a trusted cost segregation guy? As Todd said, cost seg guy. My suspicion is the majority of the people on this call do not have that person identified by name. And if that's the case, you're very likely not optimized. In my experience, over 70% of the marketplace is not optimized, which means cash is on the table, which means you're not getting the tax benefits you need. You've made misconceptions, lots of assumptions have gone on, or you're looking to your tax professional to answer all these questions for you or to make business decisions for you. If you're relying on your tax professional, not to say anything negative, those tax professionals are my friends, they're my clients, but they're not there to make decisions for you. If you're raising money and you're thinking about the future prospects of an investment, or you're looking at return on investment or cap rates, or how to take care of your friends that are investing with you, and you don't have a strategy or on depreciation, then you probably should get one. The concept's really simple, and it's about not paying your taxes ahead of time. The reason you have a cost segregation study done is so it's documented, so you sleep well at night, you take large tax deductions, and it's all above board. There are other additional benefits to it related to future expenditures. As you continue to invest or reinvest in properties, we advise CPAs on how to maximize deductions that are favorable to you. I won't go into that, but I typically have those conversations with clients that own over $100 million in real estate. So if you own over $100 million in real estate, or you're a large corporation or something along those lines, or a large fund, then having a trusted cost segregation firm is an absolute requirement. Method matters. Not all cost segregation is created equal. We've been at this for 20 years. So one of the things I would just suggest in relationship with Bill is that if you're going to do a 1031 or have plans to do a 1031 in the future, it doesn't mean you shouldn't do a cost segregation. Bill said you got to crunch the numbers, and that's true. In simple terms, without going into too much detail, I would just say the misconceptions around 1031 and 1245 property, personal property, have a lot to do with the misconceptions we see around recapture. And recapture is the number one consideration and misconception in our industry. It's something that a lot of people have just kind of thrown their hands up at and said, I don't care, I'm going to move on. But the basic idea here is that if I convert 100% expensing to personal property, might be something like carpet, and then it takes 5 or 6 years, you finally sell your property and you do it through a 1031. The allocation you make of personal property 5 years later on carpet is different than the amount that you took in expenditure or loss in the first year. And I guess many people on this call, there's a couple hundred of you, you might not think that 5-year-old carpet is worth what you paid for it originally. So, the longer you hold a property, even if you're going to 1031 out of it, can still be very net cash flow positive. And there's misconceptions around that as well. So if you're buying into a new property from a 1031, we're on an alternative investment panel. But I would just say, if you're buying back into real estate through a 1031, we just need to look at the remaining basis. And in many cases, it can still be cash flow positive again. So, my name's Timothy. If you don't have that trusted resource, feel free to reach out to me. But I'm going to hand it back over because I think what they're talking about is what to do with your money if you want to get out of real estate and go into something else. And in that situation, I may be a little bit less helpful.
Well, and a quick follow-up there, a lot of times we've got clients who have sold property or in the middle of the 1031 exchange, and maybe they identify, 3 properties. If it's under the 200% rule, they may identify a lot more than that. And they may be having a hard time deciding which property is the best one to go after. And a lot of times the cost seg study, you can go in with a quick estimate and say, these 3 properties could have, these 3 potential benefits from a study. And that might help them narrow down the field as to which one they're going to go after.
Well, Bill, you're just kind of a dork. You're thinking too much about this. You're too smart. But it is certainly true that different types of buildings have different results. And so like medical office is really, really attractive. In fact, my best studies are in self-storage, which no one would really believe, but self-storage is my best performing. A lot of times, if you're looking as an investor and you want to look at those deductions that are available with 100% expensing, it could be really large. And I'll just say, somewhere between 200,000 per million or more. It could be even 350,000 per million in loss in the first year. It's a lot of that's going to be in site improvement. So, if you have large sites, there's a lot of loss in the first year. Otherwise, different types of buildings, medical, self-storage do really well and so on. But a good point, Bill. I appreciate that insight.
You know, I tried to do an event. I have a weekly show. In case you haven't watched that, Power 30, really cool. But I wanted to get some people on, like Duane Lund, to tell us how Donald Trump paid zero taxes. And I think people like Tim had a fair bit to do with that cost segregation.
Well, he did actually. It's kind of a fun thing. You know, he mentioned tax credits and he mentioned our service. So I think really for large companies, not that the people on this call are companies, most of them are probably investors, but just suggest the people on this call, 70% of you are not taken care of, period.
Right. So let's go over to, and let's talk replacement properties for 1031 exchanges that are similar to net lease. I want to go first. I want to go to Duane, if you're there, wherever you went.
Yep. Can you hear me?
There we go. And have you talk about, and Michael already did your commercial for the one you just finished, but yeah, you've done a lot of DST, so you know the drill. How are they similar to net lease? How are they different, and what are some of the advantages to think about?
Yeah, let me hit it. And hello, Todd. Good to see you again. Hello, everybody. I guess we're the happy hour panel wrapping up the day. But
where's the drinks?
Well, here in Minnesota, and yeah, Todd, we just got that news about bars and restaurants shutting down. Not good, but cocktails soon. Yeah, and Tim, I agree with you. I would say 70% of the crowd, if you will, hasn't really looked at the advantages of cost seg and what that really means on your 1040. And Todd and I have talked about it before. I think a lot of us in this industry, I was a CPA in the 80s with Pete Marwick. Todd's a CPA. A lot of us in this industry, whether it's right or wrong, we do our long-term tax planning at the last minute. It's just the way we are. And I told Todd and I did a presentation back in March talking about the CARES Act. And that's what I'm going to talk about on this deal that we're now offering. And the NOL carryback provisions of the CARES Act, which the Whipley team did a great job talking about earlier today, but how we as individual investors can use those provisions and then hiring guys like Tim to do cost segs and generate that bonus depreciation. And I did tell Todd back in March, I said, you wait until October 15th, because that's when most of us file our tax returns. And it's usually then that most of us go, man, next year I got to do it differently. And that's when we start doing our tax planning for 2020. But guess what? We only have 2.5 months to do it. So yeah, one thing that we're doing, yeah, my partner, Michael Hogue, mentioned a DST deal that we completed recently. That was more of a yield-driven deal with Restoration Hardware. But Tim, on that deal, we managed to get on about a $30 million buy, almost $12 to $15 million of cost seg on that building. But the play of the day, and the one that we're working on, we've been trying all year to get our arms around a portfolio of convenience stores, gas stations, which are very unique because it's not really case law, but there's some provisions of the code that suggest that a fuel center, as it's known, a convenience store, if the gas sales are more than 50% of the total revenue, guess what? You can write off 100% of the property that's non-land allocated. So we have, and Todd knows this, we have a deal right now that generates almost $30 million of bonus depreciation. We decided to use the DST format to offer that. So we can also accommodate 1031 investors. But most of the demand for this C-store portfolio that we have coming out is from, I call them fresh equity investors. They're real estate professionals. Many of them are real estate brokers, but they're individuals that can use the bonus depreciation from the portfolio and take that back on their 1040, shelter this year's income. And then again, that's the beauty of the CARES Act. And Todd, I don't know if you want to go to any slides, but the beauty of that CARES Act, and Whipley talked about it, is if you generate a 2020 loss, you can take it back 5 years. And that one benefit of the CARES Act expires on 12/31. So we're kind of down to 6 weeks. And the demand for that sort of product where you can put $1 into a DST deal and get almost $2 of depreciation back, we don't have enough inventory for the demand. So we wish we had more. That's why we've been trying to buy C-stores and service stations around the country, primarily to put them in our product portfolio pipeline in 2020. But having said that, our traditional net lease deals, Tim, we hire guys like you and put well, here, I guess Todd hit the slide. And this is the bonus depreciation play of the day. Now, on the left-hand side, that's the Tax Act of 17 that we've already talked about, and then the CARES Act. And again, what most people forget in the industry is that they gave us this 5-year NOL carryback. So this is actually the portfolio that we have. It's about a $40 million transaction. And again, all we had to do on this deal is delineate between land and property. We actually didn't have to go between real and personal property because 100% of the property value is first year write-off under the fuel center kind of language of the code. So the beauty of this deal is with leverage, for every dollar in, we're selling about $1.08 of bonus depreciation. Todd just hit those next slides. I'll fly through them real quick. And what that really means, pretty simple, you know, a guy that put, or a gal that puts $1 million into this deal this year would get about $1,775,000 of depreciation. And let's just assume that individual had $250,000 of income. Obviously, you pay no taxes in 2020. But again, the beauty right now that you have 6 weeks to make the decision, hit the next slide, Todd, is right here, is now you used up $250,000 of that in 2020, but you get to carry it back 5 years. And in fact, there's a technique where you can be very creative and take it all the way back to 2013. But assuming you were a taxpayer and a real estate professional for each of the last 5 years, and I just used an example, let's assume that same individual made $250,000 a year the last 5 years and paid at a marginal rate of 35%, they can carry this loss back, recapture that $437,500, and in essence, they've gotten into a deal like this for $552,000 because they get money back from the IRS they already paid. And then again, the beauty of it is to the extent you don't use that carry back, you get to carry it forward. So in this example, someone would still have $275,000 they can carry forward to 2022. So yeah, Todd, when you talk about alternative investments, our main product candidly is 1031s. We do a lot of 1031s where it's just helping an investor buy 100% of a property. That's our NEI brokerage flag that Michael Hogue talked about. But we also do a lot of private client DSTs. Most of our DSTs, less than 5 investors. It's really a specific client that says, you know, Duane, here's what I would like to own. Let's buy it together, and we structure all the debt for them. And then now we have this bonus depreciation program that it will carry forward into 2021, but 2020 has some pretty cool provisions because of that carryback.
I used to think that I was a really smart guy. I went to law school. I was a CPA. I was an investment banking license. I could do this stuff. And Duane, you always come up with things that blow my mind. It's brilliant. It's a great strategy. I had not selling anything for Duane, but really a wonderful idea, and I love it. And the DST strategy is great. Jeff, let's go to you and talk more DSTs, because I if I remember right, I was seeing a chart one of you made a point a while ago where DST volume was going like this. So what's the attractiveness, and what kind of projects are you working on?
Yeah, thanks, Todd. So just to give a little history lesson, the DST structure has been around since 2004. And it was largely created out of some of the potential challenges, and then maybe 5 years later, what we saw as more challenges in the TIC space. There's nothing wrong with a tenant in common structure, but historically, when you bring together unrelated investors, you know, as many as 35 of them, there just ends up being challenges. I relate it to, you know, a school bus with 35 steering wheels. You know, sometimes there were issues. So the DST was created in 2004. There's a revenue ruling that backs it up, and it really wasn't put into common use, I would say, in the securitized, you know, syndicated 1031 space for probably 5 to 6 years. But I think ultimately the Great Recession kind of fleshed out the differences between TICs and DSTs, again, primarily the way that these programs are in use. So as you mentioned, the DST space as a part of commercial real estate has been on a tear every year, although this year might be a little bit of a dip down, has increased. The volume is, you know, $3 to $4 billion. And what we're seeing over the last few years, and our firm is part of this, is you know, some larger institutional players coming into the space. You know, I would say if you look at the tech industry in the mid 2000s, you know, there were probably a few household names, but there were probably a lot of firms that, unless you were in the space, you weren't familiar with, and that was fine. Now we're seeing a broadening of sponsors. There's about 30 sponsors that are in the DST space, and certainly the asset classes that are available to investors today. Obviously, some of the presenters on this panel represent, you know, some of those industries. So, you know, I would say if you were going to do a securitized 1031 in 2005, you probably had office, you probably had multi-tenant retail, and you might have had a couple of industrial properties. Now, you know, amongst the 30 sponsors that are in the space, there are firms that specialize in areas like self-storage, senior housing, student housing. You know, we're even seeing some life sciences and other offshoots of traditional asset classes. So, you know, to me, it's very exciting because the investors who need these types of solutions they're getting more numerous by the day. And what we're talking about are investors who have had a successful experience investing in commercial real estate. They might have bought duplexes in you know, in Minneapolis, or they might have been a larger scale investor investing with family members to buy, you know, a $50 million shopping center. Either way, we see a lot of folks who are coming to a point in their investing lives where they want passivity and they want a turnkey solution. And so, you know, we've really seen a kind of a resurgence, not just from a real estate and tax standpoint, but from a lifestyle standpoint where people want passive solutions like DSTs. Not to say they're perfect. You know, some people don't like the fact that they can't pick up a phone and call the property manager, but a lot of people like, you know, mailbox money, you know, the repetitiveness of, hey, I invested into $100 million multifamily property with a good manager, and maybe they even split up their money across a number of investments. And that's something that, again, the DST offered that the TIC didn't, where you know, a client with $400,000 could literally go into at least 4 different DSTs and kind of pick and choose what they want to invest into. So, you know, we see commercial real estate brokers who like DSTs because they help fill in gaps. You know, a client might have a boot gap where they don't have enough equity in their existing property purchase, so they need to fill in the gaps. But really the most recent, I think, area that we've seen a big jump has been really in COVID, because there were, as you mentioned, a lot of clients in April, May, June who couldn't leave their house or couldn't go and do due diligence on a property. And yes, the IRS granted some extensions for 1031s, but ultimately a lot of people were in a situation where they could do a DST or they could blow their exchange. So, you know, again, the industry continues to evolve, but, you know, we've seen some sponsors like a Cantor Fitzgerald come into the space, which, as much as anything, I think lends credence to the structure. And as Duane mentioned, whether you're raising capital from 5 investors or some of our programs that have hundreds of investors, the DST structure has really proven out to be a very sound wrapper to put real estate in. So hopefully that gives you kind of an overview.
I want to go to Bill for a second and see if you agree with me on this. The consternation amongst investors when you're in that ID period, which is extraordinarily stressful. I'm sure everybody online right now has gone through it, either with the client or themselves. But then I got to meet this threshold. I got to do this. I got to get to this dollar amount. I don't even like all of these properties, but I got to figure out a way. I don't want to pay tax. Boot, right? DSTs. And when we talk to Jay, don't forget about these options, because you can get really good projects in as your boot. You found one you like, you need 3, put a couple DSTs in there. What do you think of that, Bill?
Absolutely, totally agree. And like Jeff mentioned, you know, some investors love this. They want it to be their their primary target as a replacement property. Others may not love it, but it's a great supplemental. If there's a sliver of cash left, they can use the sliver of cash. And historically, in the past, they've had to pay tax on whatever's left over. Now they can put it in a DST, or they can use it as a backup if they, you know, really want to go out and find their own property, but for some reason they can't, especially with COVID-19. It's a great backup strategy. The other area we've seen a lot of benefit in is clients who sell, they're in the middle of an exchange, and all of a sudden they find out they can't qualify for financing. And the DST, you know, there's debt in place in most of them. but the client, the actual investor, is not the one they do the underwriting on. They don't have to be on the hook for the debt. They don't have to qualify for the debt. It doesn't show up on their credit report. So a lot of folks, when they find themselves backed in a corner where they can't qualify for any financing, which would mean historically they couldn't acquire replacement property, now they can with the DST as a backup.
Thank you. I had forgotten about that. I don't know that I've ever been involved with somebody who didn't qualify. What a nightmare that would be. And I think they could also work with Jay Young, right?
Absolutely. Yep. Especially that, I think Jay can
Hello?
confirm, but it's probably the same type of where it could be primary, it could be supplemental, it could be backup, and et cetera.
Jay, this was your softball.
I know. And I appreciate Bill getting in there, man. I'll tell you what, that was awesome. But no, I agree. It is a lot of boot money. We see the end of the, people love real estate. They want to stay in real estate, but what we're all about is diversification, and that's something that, our family's been in this business for 100 years, and we understand the old business. That's all we ever talk about, Todd, is oil and gas. It's kind of weird.
Well, but you have a DST now, right?
We do have a DST.
So you're in the same boat. How does that work?
And I'll tell you what, it's the same as any other DST. It's the same as a real estate because we have the minerals, we own the minerals, and we lease the minerals, and that's how we come around and talk about, we're a value add business. We're a value add business, just like apartments or real estate, any of the other assets classes that you're seeing today. We do the same thing in oil and gas. We're buying an oil field that's already been producing since 1923, been producing for almost 100 years, and it will continue to produce for another 100 years. We have a lot of work to do out there. There's a lot of things that we can do out there and drill wells and complete wells and make that money. So what we do is we go out and find these assets. And why should you invest in oil and gas? Basically right now, oil prices are down. This is when you buy, is when prices are down. You want to increase the value by drilling wells, which you increase the value a lot. I've got a lot of experience doing that. We have a lot of experience, and our track record says that, hey, you know what? Last time we did this, we got 131% return for our clients in 15 months. So we sold a third of our asset in 15 months and got 131% back to our clients. 2/3 of the asset, we're still drilling. We'll sell it, and the clients will make money when we divest in the next couple of years when oil prices go back up. You don't sell when prices are down. You sell when prices are up. So our goal right now is to go in and increase the value of these assets, doing the same thing we've done many, many times before, and getting in this oil field and drilling the wells that we need to right now. 1,000 barrels of oil per day at $40 a barrel. We're expecting, if somebody's investing a $200,000 investment, that we can get a $10,000 per month income stream. So with drilling the wells that we need to, with the initial capital that we're going to bring in, before we bring in a debt facility, any of that nature, with the initial equity, we can get this up to 1,000 barrels of oil per day. That is a $10,000 check per month to investors that put in $200,000, 60% returns. So in oil and gas, we're different. We have to give you back your money, and then we have to continue drilling, and then we look to divest the asset once the value goes up. So we want to get you back your money as soon as possible. So we love those revenue streams. That's what's kept us in the COVID business for years, is because our family's been in this business, and we picked up a lot of royalty. I picked up a lot of recurring income that we're able to monetize in today's world, which really does help us out.
I like the story, Jay, that you buy low, because I've been on this all day, and people have been talking about compressing cap rates. One of two stories: compressing cap rates if it's an asset class people like DaVita dialysis or fast food chains, or it's a product that you might be scared to death to own right now, like a bar or a nightclub or a movie theater that might be shut down for who knows how long. hey, the oil might be a good time, good time.
Yeah, and please don't think about, I'm trying to change everybody's mind on the huge, let's take all of that money that you made over 30 years and put that in there. Let's just take some boot money. Let's just take a little bit, 10, 20% of your portfolio, and you're buying an asset. And that, I feel very comfortable you putting 100% of your money in here. I do. I've got millions of dollars in here. I've got a lot of skin in the game as well. So I'm sold on this project. But if I tell you to put all your money in there, you're going to back away. So what I'm trying to do is I'm just trying to say, hey, you know what? You got a great asset here. You got a revenue stream. We're going to enjoy the revenue stream. We're going to increase the value by adding some equity, drilling some wells, and then we want to divest and just put a little bit of your portfolio in here and enjoy the benefits of oil and gas.
Yeah, you don't have to be shy. I mean, it's oil and gas. Some people want to go all in, and there's nothing wrong with that.
Right. Well, and I mean, I've done it
definitely
several
certainly a
times,
good asset
and my wife doesn't really, talk to me too much during those times. But hey, you know what? It is what it is, and it's a great business. If you know what you're doing, you get with the right people, and you can make a lot of money. But also diversification. I don't know about all the real estate people today and how much real estate, and I've heard stories about, we'll never be back to 100% of people going back to office space and things of that nature in the next year or two. And that real estate, in my opinion, is it's a great asset. You can see it, look at it, yada, yada. But man, hey, you can call me up. You can look, you can Zoom me and you can see me too, but you can also, look to diversify your portfolio. Me and Bill Exeter are going to go skydiving and scuba diving, together. So
I'll join you on the scuba diving. I'll let you skydive on your own. I'm not jumping out of a perfectly good airplane.
Oh my goodness. Wow.
Okay. Well, I've got good news and bad news. We were supposed to be done at 3:15, but Jeff Johnson gave us an extra 15 minutes. Let's do a little lightning round and have some fun since we got 15 minutes. Let's start with we're going to pick a date. I'm going to have you all predict the first date that we see a full stadium, professional sports stadium. So Bill, we'll start with you.
Ooh, I'm going to go January 1st, 2023.
What? All right. Jeff?
Is this inside or outside of the SEC?
Oh, well, okay. You know what? I said pro, but I'm going to include college football.
Okay, I was going to say, if you're including the SEC,
they have a lot at stake too.
I think next week, honestly, I would say next summer. I'm fortunate I live about 15 minutes from Red Rocks Amphitheater here in Colorado. I think it's possible we could see, again, maybe there is some element of social distancing, but I'd like to think, second, third quarter of next year, life is somewhat back to normal, but maybe I'm being overly optimistic.
Well, Duane, I have a slightly different version for you because did you ever go with Michael Hogue to the Ultimate Fighting Nights? We climb in a limo.
Yeah, we had to leave.
Oh yeah,
leave early.
Well, I want to have a redo of that, but this time I want to go see some 80s rock. Motley Crue, Poison groups coming to town. Do we think that stadium will fill up in July? Will we get to go see that?
Yeah, I don't think so. I forgot about that night. Yeah, remember people were throwing the beer bottles around. We had to get out of there. Thought we could get our own little fight. And I used to wrestle in college, but I didn't want to fight with some of those boys.
No.
I don't know, Todd. I'm not pessimistic, but unfortunately, I guess I think we're into 2022. I think next year might be another pause, unfortunately. But opening day baseball 2022, we'll be down at Target Field watching the Twins.
100% full
in the snow.
Actually, I'll be at Miller Park watching my Brewers. I'm a Badger at heart, but yeah, I think it's spring of 2022.
All right, Jay.
Well, I'm gonna go NFL season 2021. So I like the baseball, and I feel like that's a good deal. But I think we'll have football next year, 100%. And NBA,
Tim, what do you think?
at least the NBA.
Yeah, Tim.
Well, I'm from Texas. I mean, maybe Jay's from Texas too, but this won't be politically correct, and the company doesn't endorse it. But I think a lot of it has to do with who gets elected. I think that if we get a certain outcome that's you know, some people might not say favorable or otherwise, I think we might put an end to this.
I get to do my
Which
2
means
cents now. Oh, go ahead.
maybe a stadium's full January 23rd or whatever the next Sunday is, or Saturday. So maybe we'll have full back to normal sooner rather than later is my hope.
I could see that. I think people in Texas are going to be a little more brave than people in California.
I think it really is. I mean, it's kind of controversial. Maybe we're in polite company. You're kind of losing some of your participants, Todd, but you know, we have to consider whether or not we want to get back to normal and what's right and what's good. And you know, I think that it's time for men to step up and just do something and make things happen.
Everybody's entitled to their opinion on my show, and it does not reflect the opinion of anybody's company, especially including politics. I love everybody with every opinion. I'll tell you, I'm libertarian.
Well, you brought it up.
Yeah,
I want to.
I know.
Real quick. So, I mean, you asked the question to someone from Texas. So, but you know, to Duane's point, you know, he kind of stole my thunder. You know, with the lost carryback provision in the NOL. I'd like to talk to you offline, Duane. You know, because you seem to be you're on to some things, and I want to make sure we're kind of dotting our I's and crossing our T's there. But we have relationships with NAI in the past, and it seems like you're prominent with them, and they're a huge group. So, you know, I just want to kind of discuss things with you if that's okay.
Yep, absolutely.
Duane Lund, Office of the Year, NAI Global Office of the Year, right?
Yeah, we were. Yep, which was a nice honor.
He would never
right.
say something like I just said. He's too polite and too gentlemanly. So don't take it the wrong way, Duane.
Yeah, it's all good, buddy.
All right, I gotta wrap up my conversation because I've been tracking the vaccine carefully, and instead of listening to CNN and Fox News, I've been watching the people who are talking about the stocks. I believe that government might not pull us out of this because there's so many different opinions and both sides of the aisle are fighting with each other. But I trust business to pull us through, and there's money in a vaccine. So there's Pfizer and Moderna are coming out saying these vaccines work. They're effective. There's not a lot of side effects yet. Never know. But there are vaccines behind them. There are 11 more behind them, and some of them are purportedly even more effective. So I think it's May 1st, but I don't know. Okay, let's do last lightning round. I got 9 minutes. And another panel did this. Favorite asset class to buy right now within net lease. So retail, hospitality, housing, whatever category you want, industrial, restaurants, don't buy restaurants. Bill, what are you going to tell your clients when they ask?
Industrial, especially storage. I like the ability just to cut that lock and move them out and move somebody else in.
Jeff?
I would say cold storage and as a more general asset class, distribution facilities. You know, we're already shopping remotely before this, and I don't see any reason why that's going to reverse.
Tim?
I think it's pretty common consideration. I don't advise clients on what to buy, but industrial's given. I don't know if your net lease. I just think housing is always smart. So just if you're a general investor, that seems to be pretty safe.
And Jay, you can say oil. It's okay because nobody's going to argue with you.
That's the only thing I know. I don't know why we would do anything else right now. You'd obviously, look at oil and buy low, sell high. Come on, Bill. I thought me and you were buddies.
Absolutely.
I think Duane was the one that tipped me off to this, though. There was a time, was it Oklahoma, where they would pay you to take delivery of a certain number of barrels of oil?
It was all over the country. Yeah, JP Morgan came in and said, hey, guess what? We're going to have a negative oil price in April, and we did.
Yeah.
But now they're saying that oil prices are going to 190 in the next couple of years because we're not drilling for oil right now. And as we don't drill for oil, we're not going to have it on the market. I mean, we need 20 million barrels a day. We're only producing 10. Okay. And the 10 million is going down. We need oil and we don't have it. Well, what's going to happen when we need it? We go to Saudi Arabia and Russia, who dumped oil on the market back in January, February. They're going to say, hey, we're jacking the price up, baby. So you're screwed. So you're going to be paying 4, 5, 6. I'm not sure about Minnesota, what they do up there, but I'm sure you're going to pay a lot of money for gasoline in your car, before next summer because we're not going to have the oil. We're not producing it.
I can tell you one thing, we don't do solar because the sun's not shining right now. I think it's what, 3:30 here and it's already dark.
Oh
We're in
my
the North
God.
Pole.
Oh
All
my
right,
God.
Duane, what's your
Uh,
prognosis?
Well, Todd, how is it that Duane Lund ends up on a triple net lease panel after 30 years? I mean, I'm an industrial guy by background. I ran industrial REITs, was a public REIT CEO back in the day, but now I'm in the triple net lease space and I love it. And I think part of it is just the aging of the industry. We're all getting older. I'm a baby boomer. It's crazy how many of my peers that were in the multi-tenanted space are retiring. And you know what? We love this triple net lease stuff where we can get a quality property, quality tenant, and get the mailbox money. And Jay, you'll like this. My play of the day, I'm already long. C-stores, fuel stations. I love gas stations. If they're good locations, the right corner, I just think that's the play of the day. So I'm going to go long on C-stores, triple net leases.
I wish I'd have gone long on liquor stores like 2 weeks ago because we're going to need them. Well, this was fantastic. Thank you, gentlemen. The most fun I had all day was the last 10 minutes. I appreciate your ability to be lighthearted and smile and laugh with each other and also deliver a whole lot of good information. Bill, almost from beginning to end. I want to wrap it up with a comment from Ryan Severino, who's on my Power 30 show, and his comment about asset classes. Follow him. If you don't follow him at JLL, the guy who kicked off this event, Ryan Severino, he is wicked smart about real estate economics. He said workforce housing and self-storage. That's the place to go. Can't argue too much with that. I don't want to call it lowest common denominator, but the things that we need, the essential goods and services. All right, I'm going to sign everybody off. This will be available on YouTube. I better figure out how to thank our sponsors. Boy, if I can ever get there. This
Thanks,
is
everybody.
us. Hey, this is us. And thanks to our sponsors. There we go. Wonderful to have everyone. This recording will be on YouTube. You'll all be YouTubers here in a few hours or maybe by tomorrow when I get to it. Thanks everybody who signed on, who watched, the panelists, the sponsors, the whole bit, and the folks at REJournals who put this together. It was a lot of work to put together like 8 panels worth of very high level speakers. So thank you to all our team. Sayonara. We'll see you next time.
Thank you.
Thanks.
Thank you.
Thanks, Todd.